If you look at the returns so far this year for investment grade and high yield, 14% and 12%. But yet, even though it's one of the best performing sectors, it's also garnering the most pessimism regarding the future. Triple Bs, leverage loans, things are starting to get to a point where they're very large. Is large bad?
No, not at all. A lot of people are focused on the amount of debt that's coming due in the next 5 years in investment grade. It's around $4 trillion. We had $3.7 trillion come due in the last 5 years. We navigated a lot of challenges in those last 5 years, and we refinanced very, very well indeed. I'm not concerned about that, Rick.
You know, when we think of the notion that when paper disappears, well, paper disappears, the investors get their money back. So even though there's a need for corporations to lock and load new paper out there, there's also a big pile of cash in investors' hands to do it.
100%. And companies have spent a lot of time in the last couple of years in particular really fortifying their balance sheets and actively managing their liability profiles longer. Over the course of the last 5 years, yes, we've seen a lot of growth in investment grade debt, over 40% outstanding in US dollar markets, but a lot of that has very, very long maturities now. And so there's really not a refinancing problem. And ultimately that money that comes due and back into investors' coffers to reinvest, I think is going to actually find a scarcity of supply to come meet it.
Now, triple Bs have grown. So that's the lowest rung of investment grade. And they say it's now the size of close to $2.5 trillion, which is what, double the size of the junk bond market? If things deteriorate a bit, the conventional wisdom goes that giant pool on the last rung of investment grade is going to slip and create an issue. On your final thoughts, tell me why, even though a possibility, it may not be the best case for how it turns out.
Because ultimately, those with the largest debt stocks have been actively managing leverage to ensure that they're either delevering if they have very large balance sheets overall, or indeed pushing out maturities so that they can sustain any headwinds that the market might give them. You've got to remember that this year, we've actually seen $50 billion of debt upgraded out of high yield into investment grade. Only 15 has gone the other way. Sure, that trend can shift if we see a meaningful deterioration in economic activity. But as of right now, it would appear that the economy is in good balance, and ultimately we can sustain a lower level of output, which should be healthy, and triple Bs will do just fine.
And real quickly here, let's switch gears to another area of the bond market. Let's go to sovereign debt. Moody's outlook for 2020 is not very optimistic. And your final thought regarding global sovereign debt. We've seen $12.5 trillion, a much smaller number of negative yielding debt just from August to $17 trillion. Do you think there's anything positive to see on the horizon by central bankers in sovereign debt rates?
So clearly the big problem and the big question that everyone's going to grapple with over the next couple of years is, can there be an effective handoff from monetary policy to fiscal policy, particularly in Europe? Ultimately, while there has been a downgrade of the sovereign outlook by Moody's that did hit the wires, I don't think it's going to create shockwaves, and I think it's something that will be manageable for the broader economy and markets.